The problem with commercial real estate financials. So today, we're going to show you how the current and pro forma financial models are fatally flawed shortcuts from the pen and paper era, and how they under and overvalue assets, respectively, and how AdvancedREI solves these problems by using today's computing power to model real-world conditions. Now, to illustrate these points, we're going to compare three different cash flow statements: the current, pro forma, and AdvancedREIs. We'll look at 4 one-bedroom, one-baths over 12 months with a price of $500,000, market rent of $1,300, and a debt with a 70% loan-to-value, 6% interest rate over 30 years. Now, Unit 101's rent is $1,000 over 12 months is $12,000. Unit 102's rent is $875 over 12 months is $10,500. Unit 103's rent is $1,150 over 12 months is $13,800. And finally, Unit 104's rent is $1,225 over 12 months is $14,700. Now, if you add this income together, you have the gross scheduled income of $51,000. Minus a 5% vacancy factor gives us our effective gross income. Minus the operating expenses gives us our net operating income. Minus the debt and the leasing cost. And the leasing costs are $0 because, as standard practice, the industry doesn't calculate leasing costs, so we're going to exclude them here. Gives us our cash flow before taxes, our return on investment, and our gross rent multiplier. So that's how the industry calculates the current cash flow statement. But there's a problem with this statement. It isn't accurate. You see, the industry uses rough estimates instead of exact numbers. And these rough estimates underreport the property's income and undervalue the asset. Let me show you what I'm talking about. Now, if we look at the vacancy field, we're reducing the income by 5% or $2,550 because we're estimating at some point during the year there'll be a vacancy. But where is that vacancy? Every unit in every month is at current rent, which means we're not correctly calculating a vacancy. You see, in the real world, when you have a vacancy, it's a loss of income from an actual unit. And that vacancy, at some point, has an occupancy. And that occupancy, or new tenant, is charged market rent. And if the cash flow statement doesn't model this new tenant at market rent, you're underreporting the income and undervaluing the asset. Now, in addition to underreporting the income, the current cash flow statement also excludes leasing cost. These are real costs and need to be included in the cash flow statement. But understand, we're faced with the same problem we had with the vacancy factor. Since we're not identifying vacant units, there is no way to accurately determine leasing cost. So now we've seen how the vacancy factor and leasing cost affect the cash flow statement. Let's switch gears and examine the pro forma cash flow statement, the evil twin. This statement simply substitutes current rents for market rents, giving each unit the maximum annual income of $15,600 for a gross scheduled income of $62,400. Minus a 5% vacancy factor gives us our effective gross income. Minus the operating expenses gives us our net operating income. Minus the debt and the leasing cost gives us our cash flow before taxes, our return on investment, and our gross rent multiplier. So that's how the industry calculates the pro forma cash flow statement. Now the question is this statement possible? Well, I guess anything's possible, but it's the equivalent of winning the real estate investment lottery. The idea that an investor on day one can raise the rents to market without consequence is extremely unlikely. For this to happen, all the stars must be aligned. No leases, no increase in vacancies or operating expenses, and no leasing or rehabilitation cost. Every tenant must accept the rental increase as is at no cost to the investor. I wouldn't bet on it, and I consider this a very aggressive forecast and an extremely unlikely outcome. Now, it's important to note that when it comes to accounting, the SEC considers the use of pro forma statements to be tantamount to fraud, and we tend to agree. Now, if we were to look at these two cash flow statements side by side, we'd see they're polar opposites of each other. On one hand, you have the current cash flow statement, which calculates only current rents and undervalues the asset. And on the other hand, you have the pro forma cash flow statement, which only calculates market rents and overvalues the asset. The result is two extreme cash flow statements that don't model reality and have virtually no hope of performing as planned. At best, they're rough estimates, but they should never be included in any marketing material or used to make any final investment decision. Now, if we were to plot these two cash flow statements on a spectrum, we'd see the current cash flow statement is at the most conservative end of the spectrum because we're only calculating current rents, while the pro forma cash flow statement is at the most aggressive end of the spectrum because we're only calculating market rents. But the reality of operating a building is the income is a mixture of current and market rents, so the real cash flow is going to fall somewhere between these two extremes. And that's what AdvancedREI allows you to calculate, a cash flow between these two extremes. Let's take a look and see how it works. So AdvancedREI substitutes the vacancy factor for specific vacancy dates, allowing you to separate the old tenant from the new tenant by a vacancy. To illustrate this, let's model two 1-month vacancies. The first vacancy is in Unit 101 in the 3rd month, and the second vacancy is in Unit 103 in the 5th month. Now, Unit 101's rent is $1,000 for the first 2 months, and then a vacancy occurs in month 3, and it takes 1 month to release it, so we lose $1,300 in market rent from the vacancy. We then collect $1,300 a month in market rent from the new tenant who occupies that vacancy. This way we've separated the old tenant from the new tenant by a vacancy, and the model shows everyone being charged the correct rent, for an annual income of $15,000. Now, Unit 102's rent is $875 over 12 months is $10,500. Unit 103's rent is $1,150 for the first 4 months, and then a vacancy occurs in month 5, and we lose $1,300 in market rent from the vacancy. We then collect $1,300 in market rent from the new tenant who occupies the vacancy for an annual income of $15,000. Unit 104's rent is $1,225 for 12 months for an annual income of $14,700 for a gross scheduled income of $55,200. Now the vacancy is calculated by adding up all of the dollars lost from the two units, so that's $1,300 times 2 gives us a vacancy of $2,600, gives us our effective gross income, minus the operating expenses, gives us our net operating income, minus the debt, and our leasing costs are at $200 per unit, 2 units, so that's $400 in leasing cost, gives us our cash flow before taxes, our return on investment, and our gross rent multiplier. So that's how AdvancedREI calculates the cash flow statement. Now let's take a look at all 3 cash flow statements side by side and compare them. Now if we look at AdvancedREI's gross scheduled income, it's $55,200, which is an 8% increase over the current gross scheduled income of $51,000. This increase in income directly translates to an increase in reported value. Now, if we move down to the vacancy field, AdvancedREI's vacancy amount is calculated on a per unit basis, giving you total control over which units, at what month, and for how long those units are vacant. While on the other hand, the current and pro forma's vacancy amount is calculated based on some arbitrary percentage that's not specific to any building or any unit within that building. It's just a percentage that supposedly represents the majority of buildings in an entire area/city. Now, if we look down at AdvancedREI's cash flow before taxes, it's $11,719, which is a 47% increase when compared to the current cash flow before taxes of $7,969. That's even after you take into account AdvancedREI's $400 leasing cost, which, by the way, we didn't deduct for the current and pro forma cash flow statement. The end result is AdvancedREI's cash flow model is valuable to investors because they're able to make intelligent investment decisions by modeling real-world operations. While on the other hand, the current and pro forma cash flow model is actually harmful to investors because they're risking capital based on rough estimates and far-fetched forecasts. Now, to fully appreciate the benefits of using AdvancedREI's cash flow model, we need to look at it through the lens of the seller and the buyer. Now, the seller's objective is to achieve the highest price possible in the shortest period of time. In order to achieve that goal, a seller must demonstrate to a buyer a clear path to increase profits and value. So how do you do that? Now, one of the ways you do that is by modeling actual vacancies per the lease. Now, if we look back at our previous example, we have 2 leases expiring in month 3 and 5, so we model 2 vacancies. The result is we separated the old tenant from the new tenant by a vacancy and increased our reported income per the leases. Now, this doesn't mean the forecast will happen. It only means we're simulating a vacancy at the end of every lease and correctly modeling it. This approach is no different from the retail sector of commercial real estate, where you model the contractual obligations and upon lease expiration assume a vacancy, unless you know otherwise. That's the best that we can do with the information we have. Now, once the original statement has been created, we can then create additional cash flow statements showing variations of the lease, increasing or decreasing the income. This gives you the flexibility to model real-world operations, exposing the investment's true potential and risk. So, for example, a buyer could look at this forecast and say, what if Unit 103 didn't vacate? What will the cash flow statement look like then? Well, the cash flow statement goes from $11,719 to $12,019. The buyer could also say, what if it took 3 months to release the unit and $10,000 in rehabilitation cost? Our cash flow goes from $11,719 to a negative $3,018. And lastly, what if Unit 102 vacated in the 4th month? Our cash flow goes from $11,719 to $14,044. The point is, nobody knows the financial outcome 1 to 10 years from now, but the only way to make an educated guess and place a value on the asset is to first model the current operating reality per the leases, and then look at real-world scenarios based on what you believe the most likely outcome will be. It's only then can you weigh your risk and reward and make an intelligent investment decision. And that's what AdvancedREI helps real estate professionals do. Make intelligent investment decisions. So today, we've shown you that the industry standard cash flow statements are flawed estimates that are damaging your business. Vacancies are how you make money. Stop using models that minimize them. And it's possible to accurately model multiple potential outcomes with today's technology. AdvancedREI integrates everything you've seen today in the only financial analysis tool designed specifically for investors. Try it free today at AdvancedREI.com. Thank you.